Hello everyone, my name is Ed and I work as a financial analyst in our team. Today, I will bring you the second live broadcast, a strategy for European stocks in 2025. During the easing cycle, the index center is expected to rise further. Before we begin our session, let's conduct a brief test of this hardware to ensure everything is functioning properly. If you can hear my voice clearly and without any issues, please type 1 in the comments section so that both the host and the assistant can easily see your response. Thank you. Sure, let's dive into the main topic we need to discuss. First, let's take a closer look at the important disclaimer we need to review thoroughly. I'll read it briefly. Take approximately 10 seconds to read the material yourself. I won't go through it step by step for you. This detailed presentation is thoughtfully divided into 4 distinct parts. The first part is about the macroeconomics of Europe. The main point is that its ongoing economic recovery is facing numerous significant challenges. This is mainly in manufacturing and services. The second part will cover central bank monetary policies, including those of the Bank of England and the European Central Bank. We know that both the Bank of England and the European Central Bank have gradually lowered their interest rates over the course of 2024 to stimulate economic growth. We anticipate that in the year 2025, their monetary policy will continue to prioritize strategic rate cuts. In the third part of our analysis, we anticipate that the main stock indices across Europe will shift further upwards significantly. This primarily includes Germany's leading stock index, the DAX 30. France's TAC 40, the UK's FTSE 100, and the Euro Stoxx 50 are the key indices. In terms of specific industry allocation, we suggest strategically focusing on sectors such as innovative biopharmaceuticals, advanced semiconductors, and high-end luxury goods. These specific sectors exhibit distinct characteristics, often demonstrating a comparatively rapid growth rate in their respective markets. They are expected to experience a positive upward trajectory and an increasing level of prosperity in the near future. For instance, in the fields of semiconductor manufacturing and biopharmaceutical products, some sectors are more defensive. For instance, luxury goods, which include high-end products like designer clothing and fine jewelry, have a long and fascinating historical background. Thus, their overall performance tends to be more stable and defensively oriented. The final section of the presentation is the engaging interactive segment that encourages audience participation. Next, let's take a closer look at the first part, which thoroughly covers Europe's macroeconomic landscape. The overall impression is that the economic outlook is rather bleak, particularly for manufacturing and services, which face certain challenges in recovery. First, let's take a closer look at the manufacturing PMI by carefully examining the detailed chart on the right. This illustrates the Manufacturing Purchasing Managers Index, PMI, for the UK, Eurozone, Germany, and France. The dashed line indicates the limit between expansion and contraction. If the data lies below this dashed line, it clearly indicates that the manufacturing sector is currently shrinking. If the value is above this dashed line, it indicates that the manufacturing sector is experiencing growth and expansion. Now let's take a closer look, starting with the data from the UK, which is represented by this line. The UK's manufacturing PMI, which had shown signs of recovery for 6 consecutive months, has now unfortunately fallen back below the crucial expansion threshold. The latest data shows that in November 2024, the UK's manufacturing PMI unexpectedly dropped to 48, below the forecast of 48.6. This month's contraction represents the most significant decline we've seen in 9 months. This is mainly due to a decrease in domestic and international customer orders, along with ongoing supply disruptions, which have increased costs for the UK's manufacturing PMI. Now let's look at the Eurozone. The Eurozone's Manufacturing Purchasing Managers Index, PMI, has remained below the crucial expansion threshold for an extended period of 29 consecutive months. This indicates that its manufacturing sector is in a state of continuous contraction. The latest data for November 2024 indicates that the Eurozone's manufacturing PMI stands at 45.2, which aligns with market expectations but falls short of the previous value. This action also moves it significantly further away from the established expansion threshold. Notably, this indicator has been below the expansion threshold since July 2022, indicating a persistent downturn in its manufacturing sector. This particular situation could significantly lower the overall economic recovery outlook for the entire Eurozone region. This is precisely why we firmly believe that the economic recovery prospects currently appear quite bleak. Now, specifically regarding Germany and France, let's take a look at the data. Germany is represented by this bold line, while France is indicated by this distinct yellowish line. Both Germany and France's manufacturing sectors are facing significant challenges. The latest data released in November 2024 shows that France's PMI is 43.1, which is below the expected 43.2 and the previous value. It has also been below the threshold for 22 consecutive months. Germany's manufacturing data isn't much better. Its PMI is 43, which is also below both the previous figure and the anticipated value of 43.2, indicating continued contraction. It has been below the threshold for 29 consecutive months. From the latest manufacturing PMI report, we can clearly see that the sector is currently facing significant challenges and obstacles to growth. In addition to the manufacturing PMI, we can also look at the services PMI. On the right is a chart showing the services PMI for the UK, Eurozone, Germany, and France, with a dashed line indicating the threshold. Let's examine the data more closely. First, let's take a closer look at the UK. The latest data clearly shows a concerning declining trend over recent months. The latest Purchasing Managers Index PMI value for the UK has reached a near one-year low, as recorded in November 2024. The median PMI for the UK currently stands at 50.8, marking the lowest level recorded since October 2023. The dominant services sector in the UK lost momentum in November. This is mainly due to the upcoming increase in employer taxes, which has dampened hiring plans. The service sector has seen job losses for 2 months running, but the decline rate has slowed compared to October. Now let's take a look at the Eurozone. This is the line for the Eurozone. The Eurozone's service PMI has now declined and fallen back below the important growth threshold level. The latest data shows that in November 2024, the final value of the Eurozone service PMI is 49.5. This marks the very first time it has fallen below the growth threshold since January of this year. The data from Germany and France isn't much better. Germany is represented by this specific line, while France is distinctly shown by this vibrant bright green line. Germany's service PMI has dropped significantly from a reading of 51.6 in October to a lower figure of 49.3, according to the latest data released for October 2024. End of 8 months of growth has been reached. The German service sector is currently facing new pressures and challenges, as it has transitioned from a period of expansion to a concerning phase of contraction in economic activity. France's service PMI has dropped from 49.2 in October to 46.9 in November, marking 3 consecutive months of decline. Political uncertainty has weighed down the French service sector. The risk of the Born government potentially collapsing could significantly put additional pressure on the Eurozone's second largest economy, which would primarily and notably affect France and its economic stability. Upon examining the service PMI, we observe that based on the most recent data available from October 2024, the service sector is grappling with considerable challenges, and unfortunately, the overall outlook appears to be rather bleak and not optimistic for future growth or recovery. These are 2 crucial economic indicators that provide insight into the overall health of the economy: the Manufacturing and Services Purchasing Managers Index, PMI. Next, let's take a closer look at additional economic indicators that are equally significant, including inflation data, starting with the Consumer Price Index, CPI, which measures the average change over time in the prices paid by consumers for goods and services. The inflation rate in the Eurozone is showing a positive downward trend throughout 2024. This is a significant backdrop for the ECB to lower interest rates. Additionally, the ECB has revised down its inflation forecast for 2025. Let's first look at the chart on the right. The detailed chart displayed on the right illustrates the Consumer Price Index (CPI) trends for the UK, Eurozone, Germany, and France year on year. For instance, consider the year-on-year monthly value figure. This line represents the UK, with the blue line indicating the UK's values. We can observe that after experiencing a gradual decline, the UK Consumer Price Index, CPI, has demonstrated a slight rebound. The latest data from November 2024 shows the UK CPI grew by 2.6% year-on-year, up from 2.3% in October. This situation is considerably further from the Bank of England's established inflation target of 2%, as it is currently exceeding that target by a significant margin. This increase aligns with economists' previous expectations. However, it is higher than the Bank of England's forecast. The UK's Office for National Statistics stated that the CPI rebound was mainly due to rising prices of car fuels and clothing. Now, looking at the Eurozone, represented by the orange line, it has also shown a noticeable slight rebound after experiencing a continuous decline over the preceding months. The latest economic data indicates that the Eurozone Consumer Price Index, CPI, has risen above the Bank of England's target of 2%, which aligns with the European Central Bank's ECB target as well. It has significantly alleviated some concerns regarding the potential risks of deflation. Previously, the market was concerned that if the Inflation Growth Price Index, GPI, continued to decline, a deflationary situation might eventually occur. This slight rebound in market activity has eased that concern significantly among investors. The latest data shows that in November 2024, the harmonized CPI for the Eurozone rose slightly to 2.2% year-on-year, meeting market expectations. Previously, the deflation effect caused by energy prices was gradually weakening, and after the CPI fell to 1.7% in October, it has risen for 2 consecutive months. Excluding volatile items like energy, food, and tobacco, the core CPI has remained at 2.7% year-on-year for 3 consecutive months. The EU Statistics Office stated that although service costs have decreased, they are still relatively high. Non-energy industrial goods have experienced an increase for the 2nd consecutive month, indicating that there are currently no significant concerns regarding deflation in the economy. Concerning the anticipated future inflation outlooks for the years 2024, 2025, and 2026, the European Central Bank, ECB, has significantly lowered its prior inflation expectations, particularly concerning the CPI value. On December 12, 2024, the European Central Bank officially announced its comprehensive CPI forecast. It has lowered the CPI growth rate for 2024, predicting a growth rate of 2.4%, down from the previous expectation of 2.5% in September. It predicts a CPI growth rate of 2.1% for 2025, down from the previous expectation of 2.2%, and for 2026, it expects a growth rate of 1.9%, which remains unchanged from September. Overall, it has significantly lowered the Consumer Price Index, CPI, growth rate, with projections for 2025 and 2026 expected to be approximately 2%, which aligns closely with the established target set by the authorities. This steady rate indicates effective monetary policy measures in place. In addition to considering the Consumer Price Index, CPI, let's also take a closer look at another important economic indicator, the Producer Price Index, PPI, and first examine the chart displayed on the right. This chart shows the month-on-month, year-on-year PPI values for the UK, Eurozone, Germany, and France. The Producer Price Index, PPI, in the Eurozone is currently at a notably low level throughout Europe, encompassing both the UK and the policies set by the European Central Bank. This situation actually corresponds to the manufacturing PMI, which is also showing signs of weakness. According to the most recent data available from October 2024, the Eurozone's Producer Price Index, PPI, has notably decreased by 3.2% compared to the same time last year. And what about the value for November 2024? It will be announced very soon, stay tuned. The PPI values for the UK, Germany, and France for November have already been released. UK's PPI for November 2024 has seen a year-on-year decline, according to data. The PPI in Germany rose 0.1%, but it fell by 1.9% elsewhere. Germany's Producer Price Index, PPI, has at least improved and turned positive, signaling a potential economic recovery. France's Producer Price Index, PPI, however, has decreased significantly by 5.2%, remaining very weak. The PPI data for the UK, Germany, and France in November has shown some improvement. It is expected that the upcoming November PPI for the Eurozone will also show improvement. However, overall, it has not escaped from this persistent weak pattern observed. We can clearly see that many of its key performance indicators, or PPIs, are still in negative territory. Germany has just managed to turn positive. Overall, both the Consumer Price Index, CPI, and Producer Price Index, PPI, indicate that inflation trends in Europe are gradually stabilizing and showing signs of consistent improvement over time. The Eurozone has also significantly lowered its inflation forecast for the year 2025, suggesting that the recent uptick in inflation rates may be merely a temporary phenomenon. Overall, the Consumer Price Index, CPI, in the Eurozone is currently very close to reaching its desired 2% target rate. In this context, let's take a look at the monetary policy of the UK and the European Central Bank. Let's initially examine the current economy, starting with the GDP. As we can clearly see, the economy is indeed facing several significant challenges at this time. Specifically, let's take a closer look at the important GDP economic indicator. On the right side of this document, we can observe a detailed chart illustrating the quarterly year-on-year GDP growth figures. This compares the quarterly year-on-year GDP of the UK, Eurozone, Germany, and France. The latest data shows that the UK's GDP is slightly below expectations. In Q3 2024, the UK's GDP increased by 0.9% compared to last year. The growth rate is 0.5% for the second quarter, falling short of market expectations. The services sector, which dominates the UK economy, only grew by 0.1%. After the recently released economic data was made public, UK Chancellor of the Exchequer, Jeremy Hunt, voiced his clear dissatisfaction with the disappointing economic figures. The blue line clearly represents the United Kingdom, while the other line illustrates the Eurozone's data. Although the recent GDP data for the Eurozone has shown slight improvement, it unfortunately remains very sluggish overall. The latest data is for the third quarter, showing a year-on-year GDP growth of 0.9%. Quarter on quarter, it grew by 0.4%, which is basically in line with market expectations. Specifically for Germany and France, let's take a closer look at this topic. This visual represents Germany. This is France. The green line represents France. In Q3, Germany's GDP fell by 0.3% year on year, contrasting with France's 1.2% GDP growth. Martin von Sleven, the general manager of the German Chamber of Commerce, believes that Germany is facing not only cyclical crises, but also persistent structural crises. This is an informative overview of the current economic situation, and now let's take a closer look at the projected GDP growth for the coming years ahead. Data is sourced from forecasts by the European Central Bank. The European Central Bank, ECB, predicts that in the year 2024, the gross domestic product, GDP, growth rate for the Eurozone will be approximately 0.9%, indicating a modest economic expansion. For 2024, it is expected to be 0.7%, and for 2025, the GDP growth rate is projected to be 1.1%. GDP growth rate projected at 1.4% in 2026. What about the September projections? The September economic projections indicate a growth rate of 0.8% for the year 2024, 1.3% for 2025, and 1.5% for 2026. In fact, this represents a downward adjustment compared to previous estimates, indicating a reduction in future GDP growth expectations. The main reason for the downgrade is the easing of geopolitical conflicts. The global economic environment continues to face multiple challenges, coupled with weak consumer confidence and lack of business investment, leading to issues in Europe's economic outlook. Looking ahead into the near future, the German Central Bank has also revised down its economic growth forecast, now expecting the German economy to experience stagnation during the winter half of 2024, which could have significant implications for businesses and consumers alike. It is expected to recover slowly in 2025. The German Central Bank predicts a GDP contraction of 0.2% in 2024, followed by a growth of 0.2% in 2025 and 0.8% in 2026. The French central bank has also issued a similar report. It expects growth rates in the next 2 years to be below expectations. The main reason is the political turmoil in France, which has exacerbated global fluctuations and burdened the economy. The French central bank expects a 1.1% growth in 2024, followed by a 0.9% growth in 2025. Previously, it had projected a modest 1.2% GDP growth rate for the year 2025, which was revised down from its earlier, more optimistic forecast. In the United Kingdom, the economic forecast data predominantly derives from the International Monetary Fund, IMF, which has marginally increased the growth expectation for the UK economy in 2024 to 1.1%, a notable rise from the previously estimated 0.6% in April of this year. The forecast for July was set at 0.7%, while the anticipated growth rate for the year 2025 is 1.5%. This brief summary outlines the current GDP situation in Europe, incorporating the recently published economic data for the first 3 quarters of 2024, along with comprehensive overall forecasts. It also includes overall forecasts for 2025 and 2026. Overall, the current economic growth rate appears to be noticeably quite sluggish and slower than anticipated, raising concerns among analysts and policymakers. This leads to a monetary policy question. Why is its monetary policy like this? Against the backdrop of sluggish economic growth, both the ECB and the BOE have chosen to lower interest rates. First, let's look at the ECB's actions in 2024. Primarily, it cut rates 4 times. The chart on the right shows the main interest rates in the Eurozone. This includes the key benchmark interest rate, the deposit facility rate, and the marginal lending rate provided. As we learned earlier in our discussions, the Eurozone's overall economic growth is currently under significant pressure and challenges. The ECB's focus has gradually shifted from primarily curbing inflation to effectively addressing the pressing challenges associated with sustainable economic growth in the Eurozone. In 2024, the ECB lowered rates 4 times, bringing the benchmark rate to its lowest level since March 2023. The most recent European Central Bank, ECB, meeting took place in December 2024, specifically on the 12th, during which it announced a reduction of 25 basis points to the 3 primary interest rates, marking the 3rd consecutive rate cut in a row. After the cuts, the deposit facility rate is at 3%, the main refinancing rate at 3.15%, and the marginal lending rate at 3.4%. The ECB president stated that the ongoing and continuous decline in the Eurozone's inflation rate is a positive signal for the economy, but consumer spending levels have not yet recovered as anticipated. Additionally, geopolitical risks and slow global trade recovery may keep prices high, with economic downturn risks gradually emerging. Trade risks, including the potential implementation of new trade policies by President Trump, represent uncertain variables that could emerge and significantly impact international business dynamics and economic relationships. These risks must be carefully monitored and assessed. Now let us take a closer look at the Bank of England, which has also implemented rate cuts on 2 occasions during 2024. The most recent cut occurred on December 19, 2024, when the central bank officially announced its latest interest rate decision, impacting various economic sectors and financial markets significantly. The policy interest rate was maintained at 4.75 with a vote of 6-3, which basically aligns with market expectations. Regarding inflation, due to rising prices of goods and food, the CPI has increased from 1.7 in September to 2.6 in October, slightly above market expectations. It is anticipated that the overall inflation rate will continue to rise slightly in the short term. However, it will remain moderate and stable in the medium to long term. Economically, the UK's GDP growth has contracted for 2 consecutive months, marking the first time this has occurred since 2020. This recent contraction is not only the latest development, but also closely relates to the upcoming autumn budget proposals. The recent autumn budget, geopolitical factors, and trade policies contribute to increased economic uncertainty. The The monetary policy outlook for the Bank of England and the European Central Bank for 2024 will be discussed, followed by a look at 2025. We expect that the monetary policies of the ECB and BOE will likely be further adjusted downwards in 2025, with interest rates expected to be cut further. Considering the EU, the weak German economy, political turmoil in France, and potential trade impacts from Trump's return to the White House, it is anticipated that before mid-2025, the ECB will continue to lower interest rates, with the market expecting a total cut of 125 basis points in 2025. The Bank of England, in its most recent interest rate decision announcement, emphasized that before midterm inflation can adequately reach the 2% target, it is essential to allow ample time for a restrictive monetary policy to take effect. Consequently, the central bank believes that implementing gradual cuts to interest rates is a reasonable and prudent approach moving forward. However, the market remains unconvinced and has consequently increased its bets on potential rate cuts in 2025. By 2025, the Bank of England is anticipated to loosen its monetary policy by 60 basis points. Before the announcement, just before the rate decision is published, the increase to 55 G points is noted. Additionally, on December 16th, the governor of the Bank of England, Andrew Bailey, indicated that if inflation stabilizes at the 2% target level as expected, the ECB will further reduce interest rates. His statement reinforces the market's bet on further reductions in borrowing costs in the Eurozone. As the Eurozone economy has been facing ongoing struggles, concerns regarding persistently high inflation are gradually beginning to fade away and diminish. Specifically, we have observed in the recent data that his conclusion indicates considerable challenges to economic recovery, particularly with inflation levels remaining persistently low. This relates to monetary policy, specifically the policies of the ECB and the Bank of England. Now, let's take a closer look at the overall market strategy we plan to implement. An overview of the European stock market strategy. We anticipate that against the backdrop of an ongoing loosening cycle, the focus of major European stock indices is likely to shift upward in the coming weeks. The four detailed charts displayed on the right illustrate the price trends of the FTSE 100 index in the UK. The second chart represents the Euro Stoxx 50, while the third one illustrates the German DAX 30. The fourth is the CAC 40 index. Overall, during this current loosening cycle, it clearly shows a positive, upward oscillating trend that reflects gradual improvement. Since 2024, under the influence of the rate-cutting cycle, most major European stock indices have risen. As of December 20th, 2024, the overall performance of the FTSE 100, Euro Stoxx 50, DAX 30, and CAC 40 indices has been reported at 0.45%, an impressive 7.5%, a notable 38.7%, and a slight decline of 3.56% respectively, reflecting varying market conditions across Europe. Both the FTSE 100 and the DAX 30 have reached historical highs. In 2025, the ECB and Bank of England are likely to keep cutting rates. In this context, we anticipate that the focus of major European stock indices will continue to trend upward in the coming weeks. Why do we say that? It's primarily because we have previously conducted a thorough analysis on the reasons behind their decision to lower interest rates. So what does it truly mean for the focus to shift upward in a significant way? It means there will be a gradual and slow increase. During this process, there may be twists and turns, but overall it is an upward trend. In this comprehensive process, we must also pay careful attention to several potential risks, particularly the significant risk associated with rising consumer price index, CPI. If inflation rises too rapidly and unexpectedly, it may force the central bank's focus to shift significantly from promoting sustainable economic growth back toward controlling and managing inflationary pressures effectively. If inflation cannot rise too quickly, otherwise it poses a significant risk to the economy. The monetary policy should primarily focus on mitigating the risk of inflation rather than solely concentrating on fostering economic growth. This is a general strategy. Specifically, let's look at the fourth part regarding sector allocation. For sector allocation, we suggest focusing on biopharmaceuticals, semiconductors, and luxury goods. The various industries we previously mentioned are currently leading both in Europe and on a global scale, showcasing significant innovation and influence in their respective fields. For example, AstraZeneca, which has products covering over 100 countries and regions. Also, the globally renowned Louis Vuitton from France and the semiconductor equipment manufacturer ASML from the Netherlands, which is a global leader, especially in lithography. Now let's take a closer and more detailed look at these three important sections. Biopharmaceuticals are the focus. What are the characteristics of veterinary pharmaceuticals? Firstly, it has a high growth potential. And secondly, it has a strong competitive advantage, which requires substantial R&D investment. This represents its substantial competitive advantage, bolstered by considerable investment in both patents and research and development efforts. Europe's biopharmaceutical industry is very advanced, leading in R&D and innovation, and has produced many great companies. In terms of future market prospects, according to comprehensive market data forecasts, the European biopharmaceutical market is projected to reach approximately $57.13 billion by the year 2024. Furthermore, from 2024 to 2029, it is projected to grow at a compound annual growth rate of 8.89%, reaching $87.47 billion by 2029. The future market drivers for this particular industry primarily encompass several influential factors. Among these, a few stand out as particularly significant. The first and foremost is the growing aging population, which is increasingly impacting demand and shaping market dynamics in various sectors. The growth of the elderly population in Europe is driving the demand for biopharmaceutical products. This is particularly true in the chronic disease area, such as cardiovascular diseases. Another significant factor is the rising incidence of cancer. The high incidence of cancer is driving the application of biopharmaceutical products, especially in cancer treatment. The third key influencing factor that significantly impacts market trends is the launch of innovative and game-changing products. Pharmaceutical firms are consistently launching innovative products, enhancing the appeal of the market. This represents its market outlook along with several key driving factors influencing trends. From a regional perspective, Germany, France, and the UK are major countries in the European biopharmaceutical market, with Germany standing out the most. It is expected to maintain strong growth in the future. Companies like AstraZeneca from the UK, Sanofi Aventis from France, and Novo Nordisk from Denmark are all very renowned pharmaceutical manufacturers globally. For instance, AstraZeneca is a leading pharmaceutical enterprise worldwide. It was established in 1999 through the merger of the former Swedish pharmaceutical company Astra and the former British firm Zeneca. AstraZeneca leads in various fields including digestion, cardiovascular, oncology, central nervous system, anesthesia, respiratory, and anti-infection. In the first 3 quarters of 2024, total revenue reached $39,182 billion, up 19% from last year. The second company is Sanofi Aventis, often referred to as the king of vaccines due to its significant contributions to immunization. The organization boasts a robust market position, along with notable research and development advantages in areas such as diabetes, immune inflammation, vaccines, and rare diseases. In the first 3 quarters of 2024, total revenue rose by 7.04% to $36,655 billion. Novo Nordisk is also a very well-known company focusing on diabetes and weight loss. Its highly regarded representative products, semaglutide and tirzepatide, have recently been experiencing significant sales success. In the first 3 quarters of 2024, its total revenue was 20.472 billion Danish kroner, equivalent to about 30 billion. This is a 23% year-on-year increase. Among them, semaglutide alone generated 20.6 billion in sales. Just one product sold over 20 billion, you tell me, is it profitable? The second industry is semiconductors. I categorize semiconductors with 2 tags, one for high prosperity and another for strong competitive advantage. The significant rise in prosperity is primarily attributed to the recent surge in demand for artificial intelligence, which has notably boosted the need for semiconductors. Europe has become a key player in the global semiconductor industry, with significant competitiveness in semiconductor manufacturing and equipment. According to a detailed forecast conducted by Protest, the European market is anticipated to reach an impressive total of $60.79 billion by the year 2024. Furthermore, from 2024 to 2029, it is projected to grow at a compound annual growth rate of 8.93%, reaching $93.24 billion by 2029. In the semiconductor industry, integrated circuits dominate the market. The market is projected to hit $45.98 billion by 2024. The future driving factors mainly include these. The first key factor is robust policy support from various governmental bodies. And the second is that a wide range of industries in Europe are increasingly adopting innovative IoT devices, which heavily rely on advanced semiconductors for efficient data processing and seamless sensor integration to enhance operational capabilities. The third significant influencing factor is that customer preferences in the semiconductor market have shifted towards more advanced technologies, leading to a growing demand for advanced semiconductors. These are just a few of the important factors that are significantly driving its remarkable growth. From a regional perspective, Germany, France, and the Netherlands are major semiconductor manufacturing centers. These countries have invested significant funds in R&D. This has attracted multinational semiconductor companies to establish operations in Europe, promoting growth in the regional semiconductor market. Let's take a look at these companies. Key companies include ASML from the Netherlands and Infineon Technologies from Germany. There's also STMicroelectronics from Italy. ASML is quite familiar, known for lithography machines, which are semiconductor equipment. In the first 3 quarters of 2024, their total revenue was 5.926 billion euros, a year-on-year increase of 11.6%. Infineon Technologies is among the top 3 semiconductor firms in Europe. The top 3 in Europe are Infineon, STMicroelectronics, and NXP. Infineon Technologies originated from the semiconductor division of Siemens and now boasts a significant global presence with branches strategically located in California, Singapore, and Tokyo, catering to diverse markets. In the 2024 fiscal year, which refers to the entire year, Infineon's revenue was 14.955 billion euros. It is the largest semiconductor manufacturer in Germany and throughout Europe, and it ranks among the top 10 semiconductor manufacturers in the world as a whole. In the comprehensive global semiconductor sales ranking for the year 2023, Infineon Technologies secured the 9th position. Meanwhile, the third representative company in this competitive market, STMicroelectronics, achieved a respectable 10th place. STMicroelectronics, headquartered in Geneva, Switzerland, follows closely behind Infineon and is recognized as one of the top 3 semiconductor companies in Europe. The company boasts a robust network of multiple design and manufacturing centers strategically located around the world, enhancing its global reach and capabilities. The field of semiconductors. Now let's take a look at the luxury goods industry. In this informative video, I've tagged several important labels. The first one is a strong moat. It took him an exceptionally long time and considerable effort to grow from a small, humble platform to becoming a widely recognized big brand. This is his strong moat. The second crucial factor I considered is high stability. I primarily examined his financial data, which clearly demonstrates consistent and stable growth in both revenue and profit over time. This steady performance is an important indicator of the organization's resilience and reliability. Everyone can incorporate this into their strategy as a defensive sector to manage. Europe's semiconductor industry enjoys a great reputation globally, attracting many consumers and investors. In 2023, Europe's luxury goods market share accounted for about 36.5% of the global market, which is quite significant. The market, valued at $132.97 billion, thrives on a strong tradition of luxury craftsmanship and numerous iconic brands. Future driving factors primarily encompass the anticipated recovery of the tourism industry, which has been significantly developed in Europe. As tourists return to explore various destinations, they frequently indulge in purchasing luxury goods during their visits, boosting the local economy and enhancing their overall travel experience. The second influencing factor is brand innovation and sustainability. European luxury brands continuously innovate and lead trends while emphasizing sustainability, resonating with modern consumer values. From a regional market perspective, it primarily concentrates its efforts and resources in France, Italy, and Switzerland. The high-end fashion accessories, watches, and jewelry from these countries are renowned worldwide. They have a long and impressive history of rigorous quality control and exceptional design, attracting affluent individuals from all around the globe. Notable representative companies in the luxury sector include France's prestigious Louis Vuitton and Hermès International. These two well-known French companies are likely quite familiar to everyone, so I won't waste time on a basic introduction. On the last page of our report, let's take a detailed look at this topic. We previously mentioned the revenue figures and overall valuation of these prominent companies. They are all very large companies. For instance, AstraZeneca currently holds a significant market value, and it's important to note that this figure is expressed in hundreds of millions of euros. Not in dollars, but in euros, and its revenue and net profit are in dollars. AstraZeneca's total market value is 190 billion euros, just over 190 billion euros. Novo Nordisk has a market capitalization of approximately 270 billion euros, while AstraZeneca is slightly higher at 274 billion euros. Both figures reflect their strong positions in the pharmaceutical industry. Hermès and Louis Vuitton are essentially similar, as both are extremely large luxury companies, boasting impressive market values that likely range between 200 and 300 billion euros. Hermès is at 240 billion and LVMH is at 310 billion. These are all extremely large companies, and their revenue and net profits may experience fluctuations in 2023 and 2024, with pharmaceutical companies likely growing at a slightly faster rate during this period. Semiconductors may experience significant fluctuations in demand and pricing, while luxury goods tend to remain relatively stable. That's the main situation overall. And this is the main content that we will be focusing on for today. Additionally, we can also take a moment to briefly review the key points and topics we have discussed earlier to ensure everyone is on the same page and understands the material thoroughly. The first point is about Europe's macro. Let's take a look at the table of contents. The first point is about Europe's macro. The European economy is currently facing several significant challenges in its recovery process. The manufacturing and service sectors currently are not looking very promising for future growth. In this economic context, during the year 2024, both the Bank of England and the European Central Bank are expected to continue implementing cuts to interest rates, while the overall economy will still encounter several significant challenges in its ongoing recovery process. Given this backdrop, we expect the European Central Bank and the Bank of England to further lower interest rates in 2025. The interest rate cuts by the ECB and the Federal Reserve will create a favorable environment for stocks. We expect that the major stock market indices will likely see their focus shift upward and improve in performance by 2025. When selecting industries, we recommend focusing on sectors like biopharmaceuticals, semiconductors, and luxury goods. These industries are currently leading on a global scale, particularly in various sectors throughout Europe. Notable representative companies include AstraZeneca in the biopharmaceutical sector, ASML, and ST Microelectronics in the cutting-edge semiconductor industry, and Hermès in the prestigious luxury goods market. That's the main content we had planned for today. Now let's see if anyone has any additional questions or points they'd like to discuss. Any more questions? If you have any questions or need further clarification, please feel free to post them in the comments section below. If you have any questions, please post them in the comments. It seems that someone would like to take a moment to review the representative companies that were mentioned earlier. as the information was presented too quickly to absorb effectively. The representative companies in the semiconductor sector include AstraZeneca in pharmaceuticals. The pharmaceutical companies France's Sanofi and Denmark's Novo Nordisk are industry leaders. We should review this table. Let's take a closer look at this detailed table. The letter L here specifically represents the UK market, while the abbreviation PA signifies the French market, providing a clear comparison between them. The F represents the German market. This is AstraZeneca, a prominent pharmaceutical company based in the UK, and Sanofi, a leading healthcare firm originating from France. Nocta, a group from Germany. Harlandau from ASMEC. Infineon Technologies from Germany, ST Microelectronics from France, Louis Vuitton from France, and Hermes International from France are the main companies. Are there any more questions from everyone? If there are no additional questions from the audience, then we'll go ahead and wrap up today's live stream, since there is another exciting live stream scheduled to start shortly. I won't take up more of your time. If you have any questions or topics you'd like to discuss in greater detail, we can certainly address those during our next live stream session. Thank you very much for your participation, everyone.